Beating the Street 15 Core Concepts from Peter Lynch. A comprehensive guide to Peter Lynch's investment philosophy that delivered 29% annual return over 13 years. Learn the strategies that turn personal observation into multi-bagger opportunities. Presented by Jay Nahar, Soumya Jain, Yash Sangoi, and Ritik Maswekar. First concept, know what you own, your personal information edge. Peter Lynch taught that individual investors have distinct advantage over Wall Street. Their capacity for personal observations. By tapping into your everyday experiences, you can identify promising investments long before the professionals. The real life example that Lynch gave for this was that Lynch noticed long lines at Starbucks stores during his personal visits in the 1980s. He recognized the customers' loyalty and expansion potential before Wall Street analysts covered it, leading to one of his successful investments. Key points he gave for this learnings were on-site visits, observe customers, and gauge demand. Moving on to the next slide. Valuation and financial screening. Peter Lynch's approach to investing emphasizes on diligent valuations. By applying strict financial screening rules and ensuring a substantial margin of safety, investors can protect their capital and identify truly undervalued opportunities. First, Rule of 5 screening, a quick mental checklist covering revenue growth, profitability, balance sheet strength, cash flows, and sensible PE ratios. Second, PE ratio analysis. Compare price to earnings to growth and industry peers to gauge if a stock is reasonably priced. Third, margin of safety. Always buy stocks for significantly less than their intrinsic value, creating a buffer against unforeseen problems. For example, during the 2009 financial crisis, Apple stock traded at a PE of 12. Despite the market downturn, the company maintained a strong balance sheet and continued to see growing iPhone sales. This combination provided a significant margin of safety as the stock was undervalued relative to its growing potential. Moving on to the next topic, market cycles and macro timing. Looking at the bigger picture, Peter Lynch understood that every great company operates within a broader economic context. While he wasn't a market timer, he recognized the importance of understanding economic cycles. Here are the 4 points he viewed for. First, economic cycles recognize the patterns of expansion, peak, contraction, and trough that define the broader economy. Second, trough opportunity. Cyclical stocks are best bought when they are out of favor and cheap during economic downturns. Third, long-term view. Avoid precise market timing, but use macro understanding to position investment wisely within their natural cycles. Fourth, peak exit. Consider selling cyclicals as the economy reaches its peak and sentiments becomes overly optimistic. Example for this was Lynch bought Caterpillar stock in 1982 during a severe recession when the construction activity was at historic lows. The stock was trading at depressed valuations as the economy recovered in mid-1980s. Construction boomed and Caterpillar's earnings surged, delivering exceptional returns. Moving on to the next point, portfolio construction and diversification. The sweet spot, 15 to 30 stocks balanced across types. Lynch advocated the diversified portfolio, but not one that was over-diversified. For individual investors, he suggested holding between 15 to 30 stocks. Here are the 4 types of stocks he advised holding. First, fast growers, small aggressive companies expanding big earnings at 20-25% a year. These are Lynch's favorite for multi-baggers. Second, stalwarts, large well-established companies growing at 10 to 12% annually. They provide stability and defense during economic downturns. Third, cyclicals, companies whose sales and profits rise and fall in predictable cycles. Timing entries and exits is crucial here. Fourth, turnaround, companies on brink of collapse but with strong potential for recovery. High risk but high reward if successful. During his tenure at the fund, Lynch had balanced portfolio with fast growers like Dunkin' Donuts, the limited retail, stalwarts like General Electric, Coca-Cola for stability, cyclicals like Ford, etc., and the turnarounds like Chrysler. In early 1980s, when it was near bankruptcy but recovered dramatically, this diversification across types helped him achieve consistent returns. Handing over to Jay.
Timing and entry exit decision. Peter Lynch's philosophy on sentiment driven investing, buy when pessimism is high and sell when optimism peaks. Instead of trying to time exact market bottoms or tops, Lynch focused on reading market psychology. Buy signals appear during periods of heavy pessimism when news is overwhelmingly negative, analysts are uniformly bearish, and valuations fall far below a company's long-term potential. At such moments, growth companies are often ignored by the broader market, creating attractive entry opportunities. On the other hand, sell signals emerge when a stock becomes extremely popular. Excessive optimism drives valuation far above fundamentals, and even when the company's performance starts weakening, the market ignores it. Such irrational exuberance typically attracts speculative buying, signaling danger. The example provided is Fannie Mae 1984. At that time, the market feared housing and interest rate risk. Sentiment was extremely bearish, and the stock traded at a low P of around 4x. Lynch saw that fundamentals were still strong. As sentiment improved and the housing market recovered, the stock becomes a 10 bagger. This perfectly illustrates that the best buying happens in fear and best selling happens in euphoria. Moving on to the next concept, company analysis and financial evaluation. Before investing, understand the company inside out. Peter Lynch believes that strong fundamentals protect investors from risk and help identify undervalued opportunities. The income statement is the first place to start. It shows revenue growth, operating expenses, profitability trends. Increasing scales with stable or improving margins usually indicate a healthy business. Next is the balance sheet, which highlights how financially strong the company is. By studying assets, liabilities, and shareholder equity, an investor can understand whether the company is solvent and capable of sustaining operation even in tough conditions. The cash flow statement is equally important. It reveals actual cash being generated, not just accounting profits. Strong operating cash flows to show a business that can fund expansion, pay dividend, and reduce debt. Finally, debt management assesses the company's leverage. Peter Lynch preferred companies with manageable debt, strong interest coverage, and low reliance on external borrowing. The P valuation was reasonable and fundamentals were improving. This deep understanding gave him the conviction to hold the stock through volatility, eventually turning into a the mango. Overall, this slide teaches the thorough fundamental analysis is non-negotiable in long-term investing. Growth, moving on to the next concept, growth versus value rotation strategy. Peter Lynch's style of shifting between growth and value depending on market condition. Growth stocks works best when the economy is strong, interest rates are stable, investor sentiment is optimistic. Value stocks outperform when markets are uncertain, growth slows, or when valuation become excessive. Peter Lynch didn't stick to one style. He analyzed relative valuation. Are growth stock P's too high? Macro indicators, inflation, interest rate, liquidity, sentiment. Are investors euphoric or fearful? Before the 1987 crash, growth stocks become extremely expensive, so Peter Lynch rotated into undervalued names, which helped the Magellan Fund recover faster after the downturn. The lesson flexibility adds protection and enhances returns. Market shift and the best investors shift with them. Moving on to the next concept, international and country fund opportunities. This slide introduces how global market creates opportunities because different countries have different valuation, growth rates, and investor attention level. Peter Lynch used country funds, funds that invest in a basket of companies within a specific country to capture these opportunities without needing to pick individual foreign stocks. Two key ideas. First is valuation gaps. Some countries trade cheaply due to fear, recession, or lack of coverage. Second, NAV discount, which means country funds sometimes trade below the actual underlying value. Buying at a discount gives double upside. The market rising plus discount narrowing. The Korea fund example shows this well. Peter Lynch bought when it was trading at a 30% discount, and as Korea market improved and discount closed, the return were amplified. The message is global diversification plus valuation gaps equals strong opportunities. Moving on to Ritik.
Let's try and understand what is the difference between stocks versus bonds. As Peter Lynch has explained in the book, stocks are usually ones which are there for huge growth potential, whereas bonds, the growth is quite limited. The compounding rate in stock is much more than what is available and seen on in the case of bonds. In the historical data comparison, Peter Lynch has compared 1926 to a period from 1926 to 1990. Here, the stocks approximately returned 10% annually, while the bonds only returned 5%. For an example, if a 10,000 investment in a stocks in 1926 would have grown to over $1 million to 1990, while the same in the bonds, would have grown to only about $50,000. The reason behind this is in the case of stocks, you get ownership of the company and you grow as the company grows. Whereas in the bonds, you are only a limited partner there, so you are only owed. So you only the reinvestment return is only up to the interest rate which is there on the bonds. So that's what is explained below. Stock in the stock, growth and compounding is there. In the bonds, there is stability as well as there is income. Moving on to the next concept. So here, Peter Lynch has tried to explain that the timing of a investment is pretty crucial. So in case of cyclical investing, people tend to buy when the sentiments are already high, and that is actually the wrong time to buy. So here he has tried to explain with the case of a blackjack, where where you should always buy when the sentiments are low, so as to because the prices become so cheap that in order to gain significant investment returns, it is the best possible time. And then you sell at a time where the prices are when the profits are at such a peak that there is and the prices also value it so much that there is no possibility of any gain in the future. So that is the possible time, that is the best way investing in a cyclical making a cyclical investment. So while identifying cyclical industries, we should focus on sectors whose profitability directly correlates with the overall health of the economy. These companies thrive in expansions and struggle in contractions. And as I mentioned before, you should always buy at the trough and always sell at the peak, because here at the trough, the earnings are comparatively low and the stock prices, because of that, are significantly depressed because people believe because there's a widespread pessimism and people believe that it is not going to go up again. And at the same time, while at the peak, the earnings are very high and the market sentiments drive the stock prices to their historical highs, anticipating the next downturn. Peter Lynch used this example while investing in Ford Motor Company in 1982, where he bought the stock for $4 per share, and then the stock hit $20 per share in just 2 years. This perfectly demonstrates the blackjack principle of buying cyclicals at the trough. Moving on to the next concept. So here there is a where people try to forecast crisis. In the terms of crisis, people believe that because the stock price has fallen, it means that the company will going to be bankrupt and all that. However, when we are doing the contrarian approach, we should always be aware that there are temporary setbacks as well as there is structural damage. In case of temporary setbacks, it is good to invest in such a thing, but in the case of structure, you should not try to invest in a company. Here we are in the case of three blocks which are shown there. We see fear and negative sentiment dominate, and that's why the trades are at significant discounts. This creates prime opportunity for patient investors to acquire solid companies cheaply. And to distinguish between temporary versus structural, the distinguish between the transient operational issues such as product recall, short-term economic dips, and fundamental long-term structural problems that could impair a business. So we should be very mindful with what the issue is. Is it temporary or structural? And the final, in the case of, and let's try to go forward with an example. The Deepwater Horizon spill sent the BP stock plummeting. Investor who recognize the temporary nature of the crisis and BP's underlying value find a excellent buying opportunity. So that's is what is example there, and there is also example mentioned in the book regarding savings and loan crisis. So going on. In the case of small cap multi-baggers, Peter Lynch discovered the strategy of looking small and overlooked companies which has an immense growth potential. These companies are barely looked by top investment managers because the huge pool of capital which they are unable to invest in such small companies. And therefore, the information edge amongst these small companies is very huge. So while investing in these companies, there is a need of early discovery. We should always focus on identifying innovative, well managed small cap companies that are often ignored by institutional investors due to the size or nascent stage. Patient cultivation. We should always invest for long term, allowing the company sufficient time to execute its growth strategies and not sell off just because of 1 2 bad quarters. This is a long term game, and as it expands, as the company expands its market and increase profitability, it will grow exponentially. And that's what is there. And the last one, and at the end, you reap exponential rewards from the same. For an example, in the book, there is example of La Quinta Motor Range. Lynch discovered that this small motel chain in the early 1980s had only 150 locations and was largely unknown to the Wall Street. He bought that shares for at $6. Later, the company had a proven business model, strong management, and was expanding rapidly into the unobserved markets. Over the 5 years, La Quinta grew to 400 plus location, and the stock reached $60 per share, a 10 bagger. Wall Street analysts only started covering it after it had multiplied several times. So this shows that you should never overlook small cap multi baggers and try to win opportunities in them. The next concept will be explained by my teammate Soumya.
So coming on to the topic of sector rotation. So what basically is sector rotation? Sector rotation is an investment strategy that means moving money between different industries based on where the economy is in its cycle. The idea is simple. Not all industries perform well at the same time. So what do investors do? Investors first identify whether the economy is expanding, peaking, shrinking, or recovering. Then they shift their investments into sectors that have historically done well in that phase. For example, tech during expansion or consumer staples during downturns. Now let's understand this with the help of a real life example. Now, what did Peter Lynch do in the 1980s? Now, during the 1982 recession, he invested in safe consumer staples. But when the economy recovered in 1983, he moved on to cyclical sectors like autos and housing. Then, near the peak of 1984 to 1985, he focused on tech and healthcare. Then, again, in the 1987 crash, he reduced his risk and shifted back to stable companies. This smart rotation helped his fund consistently outperform the market. So, now moving on to the next topic, insider buying signals. Insider buying signals are basically signs that the people run a company, like the CEO, CFO, and the board members, are confident about its future. Peter Lynch emphasized that when insiders use their own personal money to buy shares in the open market, it's very meaningful. This is very different from receiving stock options or grant. It shows that they are willingly investing their own cash in their own company, because insiders have the most accurate information about the company's health, information projects, and long-term strategy. So when they buy, it usually signals that something good is going to happen in their company. Now, Peter Lynch has given a strong example of Pier 1 imports in the 1980s. Let's understand that. He noticed that several top executives were aggressively buying shares when the stock was just $8. This stood out to him, but insiders rarely buy in large amounts unless they truly expect improvement. After investigating, he learned that the company was going through a successful turnaround that wasn't yet visible in the stock price. Lynch bought shares too, and within 18 months the stock rose to $22. The heavy insider buying was one of the earliest signs that the company's prospects were rapidly improving. Now, moving on to the third slide. Peter Lynch believed that to truly understand the stock, you need to follow a clear timeline of the company's story. Now, let's understand this by three things. First, the first step in the business narrative, understanding how the company started, its missions, its founding principles, and the specific market it needs to solve. Next comes competitive advantages, or the moat. This is what protects the company from competitors such as superior technology, strong branding, network effects, or a cost advantage. Finally, you look at the future growth drivers, which are the catalysts that will push the company forward, like the product launches, market expansion, demographic shifts, or the global opportunities. Now, let us understand this with the help of a real world example. Lynch applied this timeline to Walmart in the 1980s. Sam Waltman's mission to deliver low prices to small towns. Its moat was an unmatched logistics and distribution system, and its growth drivers included rapid expansion from 150 stores to over 1,000 and entering new markets. Understanding this timeline helped Lynch see why what Walmart would succeed in the long term. Then the next slide. Let's understand this entire book in 6 key points. First, personal knowledge. What does personal knowledge tell you? Invest only in businesses you understand from your work and daily life. Second, portfolio balance. Spread investments across sectors and themes so one bad area does not sink the whole portfolio. Then, third, crisis buying. Use crashes and panic to accumulate strong companies at bargain prices instead of running away. Focus on firms whose fundamentals remain intact even though their stock price has been hit. Then the next point, valuation discipline. Buy only when the price is justified by earnings power and future growth, not just a good story. Then cycle awareness. Recognize that sectors move in cycles. Cyclicals are most attractive when sentiments and profit are at their worst. Shift exposure gradually as business cycles turn without turning to time every short term move. Multi-baggers. Hunt for underfollowed small and mid caps that can grow earnings for many years. Now moving on to the current affairs section.
Here we'll discuss the recent developments in few of the current affair topics. First, gold. Gold prices surged to all-time high amid global uncertainty. Central banks increase gold reserves as hedge against inflation. Retail demand for gold jewelry remains strong in key markets. Gold ETFs see significant inflows from institutional investors.
In the case of PLI, which is a production-linked incentive, government has been very vocal about this scheme and has invested a lot of money through this scheme. India's PLI scheme attracts over $100 billion plus investment commitments from the government, and it is primarily focused on four sectors, basically electronics, pharma, auto, textiles, and somewhat food processing as well. Government has been very vocal about the electronic segment where they want to create a semiconductor hub in our own country, which is currently led by Taiwan. However, for that we need to be a significant investment as well as time need to be there for this investment, for this plan to get executed. There has also been a manufacturing capacity expansion that has accelerated across sectors, and through this investment there has been multiple job creation targets, and it has been directly on track with more than 1 million plus direct employment expected through the scheme.
Now coming on to AI and technology. Let's understand what has happened in the few weeks or the past few months in the AI and technology sector. So first, generative AI tools like ChatGPT are transforming business operations worldwide. And now India is also very serious about AI and technology. And how do we know that? We know that because of the following reasons. India is launching a national AI mission with a focus on developing indigenous AI models. And despite of tech layoffs, demand and hiring for AI and ML roles are rising. The government is also very serious about AI and technology. They are working on regulatory frameworks to govern and manage AI responsibly. Moving on to the next topic.
In case of interest rates, we have seen like a Fed has maintained a higher for longer stance on interest rates. The repo rate has also been steady at 6.5% amid inflation concerns, because we need currently inflation for our economy to keep growing. Also, in case of ECB, this it has also signaled potential rate cut in H2 2025. Emerging markets face currency pressures from also the rate differentials.
Geopolitics. Global geopolitics in 2025 is dominated by few key flashpoints. First is US-China tensions continues to rise, especially over Taiwan, technology sanctions, and trade restrictions. This keeps global supply chain uncertain and pushes companies toward diversification. Second is the Russia-Ukraine conflict. still affects global energy and food security. Commodity prices remain sensitive, and European markets particularly feel the impact. Third is the Middle East tensions continue to create volatility in global crude oil supply. Even small escalations push oil prices up, affecting inflation for import-dependent economies. Fourth is India's strategic position in the Indo-Pacific strengthens with new partnership in defense technology and trade, making India a key geopolitical balancing power in Asia. India's market story continues to stand out globally because of its consistent long-term growth trajectory. For the last 45 years, India has delivered an average real GDP growth of 6% per annum, making it one of the fastest growing major economies. This long runway of growth is supported by structural strength rather than short-term cycle. One major improvement has been inflation management. Compared to the past levels of 8 to 10%, inflation has gradually moderated to around 4% thanks to better monetary policy framework, food supply management, and inflation targeting by the RBI. This creates a stable environment for business and investors. The key growth drivers of Indian market are also unique. India has a demographic dividend with a young and expanding workforce that fuels consumption and productivity, alongside political stability and continuous reforms in taxation, banking, manufacturing, and digital infrastructure, strengthens investor confidence. Moving on to Ritik.
Here we can see in the case of IIP, which is a index for industrial production, we can see for the past 3 to 4 months, like it has been like post September, it has a decline. However, this doesn't show a true picture of this because during that period there is a very big festival which is celebrated in India, that is Diwali, and during that terms a lot of workers they go on holidays. So because of that, the production might have dipped slightly in that month. However, later we will keep continuously monitoring this trend. If it is going downwards, then it is a worry because we need production in our country to go up. However, I feel like in the next couple of months, it will be back to the range of 4 to 4.1, which is exactly which has been pre-Diwali. And let's talk. And my teammate will talk about inflation trend.
Now, moving on to the inflation trend, the chart shows a clear cooling trend in inflation from July to October 2025. Inflation rises from 1.61%, as you can see in July, to a peak of 2.07% in August, indicating temporary price pressures, likely from seasonal or supply side factors. After that, inflation steadily declines to 1.44% in September, as you can see in the chart, and drops sharply to 0.25% in October, suggesting easing demand, improved supply conditions, or policy tightening taking effect. Overall, the trend signals strong disinflation. Now, moving on to the PMI trend.
PMI trend. We have two lines: is manufacturing PMI, which is yellow, and service PMI, which is blue. Manufacturing PMI falls from 59.3 to 56.6. The reasons are higher interest rates globally, weaker export demand, raw material cost pressure eases, but new orders slow down. Firms reduce production slightly in response to weaker global trade cycles. Second is service PMI falls from 62.9 to 58.9, then rises to 59.8 on natural cooling after months of strong expansion. Services were running very hot earlier. Normalization of demand in travel, hospitality, IT, and financial services. Slight weakening in international client order, but the rebound in November 2025 shows domestic service demand remains strong. In simple terms, manufacturing slows because of export weakness and global condition. Services cool from a very high levels but remain in solid expansion. PMI is still well above the 50, meaning the economy continues to expand just at a slower pace. Thank you.